Good morning to all of our wonderful champions. And I'm Rita Santamaria. I'm the owner, founder of Champions School of Real Estate. And I welcome you to our 2020 Midyear Industry Outlook. And as all of you know, we have gone through the most interesting time period that for years and years to come, we will have so many stories to give to our families, our friends, and they will not believe what we have all gone through these last few months. But I want to start out by saying, as the owner founder of Champions School of Real Estate, thank you for your business. We have had our live broadcasts since 2016. We've had our wonderful online delivery since 2004. We had no idea on March the 14th how amazing these two deliveries would help all of our customers, all of our new people, all of our continuing ed people. And I just read in the Texas Association of Realtors magazine yesterday that 55% of all of you with a license have taken your continuing education over these few months. So congratulations. It was definitely making the best use of your time. And for those of you going into real estate, I have to thank you as well for taking our live courses, live broadcast with our fantastic instructors that are in front of you right now. Our instructors that you've been taking your courses from have all been with us for many years. They are specialists in the industry. And without our instructors, we would not have the thousands of happy students that we have. And without our staff who has taken care of you with the registration, with counseling, with podium, which means it's a chat line, like 500 people a day that we chat with to make sure that all of your questions are answered. So, staff, thank you so much. And I know so many of you are wondering, when are you going to open up your brick and mortar classes? Well, that will be September the 8th. As with the public school system, where there's been a limited opening, we're doing a limited opening September the 8th, the day after Labor Day, a Tuesday, and we will have qualifying real estate courses available at all of our campuses, as well as continuing with our online and our live delivery, which you all have so loved and gravitated to. I just cannot thank you enough for all of the business that you have given Champions School of Real Estate that has allowed our business to go forward. And but we're so happy to be back at our campuses, our brick and mortar. I know in the brand new Austin campus, our president offices over there, Kimberly Didelowitz, and she's been with Champions 22 years this month. We celebrated that just last week. We also celebrated the fellow that makes sure that everything's going great with Champions Live, Henry Britt, the director of the Live department. He is our 2021 Employee of the Year. Congratulations again, Henry Britt. And all of our 14 employees were acknowledged, congratulated last week because they've been with us, those 14, for over 10 years, up to Connie Sanders, the manager at the 1960 campus, for 20 years. So all of that, as well as all of that celebration, as well as just celebrating that so many of you have written us the kindest testimonials. I call them love letters. And that keeps us going every day because in this particular point in time, we love hearing your kindness. We love hearing those positive testimonials on how we have helped you. And it's definitely been you have helped us, we have helped you, and there's nothing more gratifying. Thank you again. I also want to say thank you, Dr. Gaines. We absolutely love our Jim Gaines. He says, call me Jim. I'm like, there is no way, Dr. Gaines. Your background, you're the chief economist at the Real Estate Center at Texas A&M University, whom we all admire, an amazing university. And Dr. Gaines has been there for many years. In fact, some of you may not know that the Texas legislature in 1971 put together, funded the Real Estate Center, and it is the nation's largest publicly funded research organization. The funding comes from our licensees as real estate fees that we have to pay every 2 years. That is funding. And the information that we get in Terra Grande, the information that we get online is just incredible. Hello, Dr. Gaines.
Good morning, everybody. How are we doing? Like everybody, I'm working at home. Rita made mention I've got 2 yellow labs that every once in a while walk around at the French doors right back over my shoulder and look in to see what I'm doing. So if you see them back there, don't worry about it, nor if you hear them bark. It's inevitable. It's Murphy's Law that something will happen during the presentation that they'll show up. Anyway, I appreciate it very much. Let's see if I can get us going and get the screen up. I hope you can see the screen share. Rita, are we seeing it?
Perfect. It looks awesome.
All right. As all of you will see, in today's market, all bets are off. That's the best way I know how to tell you. We haven't been through anything like this before. And it's just a prelude to what I'm going to tell you. Just to tell you how smart the economists around the world and around the country are, I can tell you that nobody knows exactly what's happening or what's going to happen. There's no precedent for this. It's not happened before, so we're not real sure. So as you can see, what I've entitled the whole presentation is all bets are off. On the other hand, the real estate's been doing pretty well. Here's my first commercial. This is the website address that Rita was kind enough to mention. This is recenter.tamu.edu. Everything we do at the Real Estate Center, we put on our website. It's all free. You'll have to go out and kind of play with it a little bit. You can see where I got the red circle up there at the top. You download, you get drop-down boxes from the research and data and so forth, and you can download to your heart's content. All of the reports that we do, we put out online, and you can see these are a little dated, but you'll get it more updated. We update it almost weekly. So please do go out to the website and look around and learn how to find the data that you'll be most interested in. One of the things I will emphasize, we do have data about each of the areas. Every MSA is covered. We have links to other sources of information if you need that. There's just a whole world out there. Here's what's going on, and I'm going to take you through a little bit of just national economics, because everything that's going on in the nation is we're a microcosm of that here in Texas, so we're seeing it. We're officially in a recession, so if anybody asks you, you can talk knowledgeably or more or less sound like an economist, but you know what you're doing whether you do or don't. Second quarter of this year, worst on records. Couple of months, April and May, worst on record. I took the other quote that don't have a clue. For those of you who were like me back in April and so forth, and were watching the daily press conferences from the White House on the virus, and you had Dr. Fauci and you had Dr. Birx and of course the president and vice president were there. And one of the reporters asked the president what his economic advisors were advising him. And he kind of looked at the reporter and he said, they don't have a clue. And I thought that was one of the best answers that I heard in the entire press conference sequence. But anyway, and he was exactly correct, what he said. NBER, the National Bureau of Economic Research, which is an organization of economists, has a subcommittee that does market cycles, and they are the ones who officially earmark and say we're at peaks, we're at troughs, we're in recession, we're in boom, we're expansion. They officially announced here a few months ago that February 2020 was the peak month of the recovery from the Great Recession that we had back in 2007, 8, and 9. So after 128 months of continuous economic expansion, almost unprecedented growth for that period of time, particularly in Texas, and I'll show you that in a little while. But after 128 months, February peaked, everything went downhill, of course, in March, April, May, and really just in the last month or so is beginning to turn around. So officially gone into official recession. How bad is it? Well, the buzzword worst on record, that applies to the second quarter of this year. Economists generally look at data on kind of a quarterly basis. We don't get too concerned about monthly, but nevertheless, we look at that too. Unemployment claims, you're seeing that in the paper, you're hearing it in the press. I'll show you, in fact, the dates here are wrong. This 55 million is through August 8th. About a third or a little more of everybody who was employed back in February applied for unemployment insurance somewhere between the period of March 15th and August 8th. They should say August 8th. In Texas, those claims were up around 3 million, about 23, almost a quarter of every 25% of the workforce in Texas applied for unemployment claims. As all of you are probably aware, I'm assuming that you are, Texas got hit with really a double whammy here. Back in January and February, when actually the economy was still rolling and actually still prosperous and continued growth, Saudi Arabia and Russia got together and decided to have an oil price war by increasing production and reducing the price of oil. And they were successful. They pulled it off. Well, of course, that affects Texas a great deal. You can't ignore what's going on around the world because it comes back home to Texas very quickly, particularly in the energy and the oil and gas market. So anyway, price of oil went down. It collapsed completely. In fact, in April, on one day, the price of West Texas Intermediate went to negative $35 a barrel. The producers were literally having to pay people to take the oil off their hands. They couldn't sell it. They couldn't even give it away. They had to pay people to take it because they were producing so much. That was a very short term, and it occurred on one day. It bounced back. Although I got to tell you, the average price for that week was real low. But for the month, and since then, we've come back up to about $40 a barrel, and it's more or less stayed there. I'll talk a little bit more about that. Mortgages, the mortgage market, of course, with all of these people going unemployed. And then we had the programs. We had the PPP. We had the extra unemployment insurance from the federal government of $600 a week and so forth. And they declared a moratorium on foreclosures, on mortgage foreclosures, and allowed borrowers forbearance. Forbearance means you could skip a month's payment or 2 months' payment. And in fact, the way it was read, if you work with your lender, theoretically, you could even get up to a year's forbearance. I don't know if that's happened or not. We peaked out at nearly 5 million mortgages applied for the forbearance and were granted. Probably more wanted it, but for various and sundry reasons didn't do it. That's come down. It's down to about 4.1. In fact, I'm waiting on new numbers on that here in the next few days. I suspect that it might even be slightly less than 4 anymore. We'll have to see how that forbearance program works. And of course, lastly, how bad is it? Monetary policy, the fiscal policy, the federal deficit's going to go through the roof. It's already there. We're already over 100% of 1 year GDP. The Treasury borrowed $3 trillion. That's trillion with a T in second quarter alone. It's been extremely expansive. A lot of economists are and a lot of people are worried about what the Fed and what the Treasury is going to do, what the government's going to do, how much money they're going to spend, money that they actually have to borrow. They don't actually have the money. They have to go borrow it and then pay it out. The extra $600 a week on unemployment, which gave out July 31st. I'm aware of that. And of course, our wonderful Congress went on vacation and didn't pass another bill. So we don't know what's going to happen. There's a lot of speculation that they'll come back and pass some kind of bill and make it retroactive, but it really won't help a lot of people with that. You can't delay your bills if you don't have your income. So we'll have to see about all of that. What is recovery? I'm going to jump ahead a little bit here. What's the recovery going to look like, and what to look for if you're looking for recovery in our economy? And I really should have had another line on this slide. It got wordy enough as it is. You know, I know all you instructors out there are looking at my slides saying, "Oh God, what lousy slides! Too many words." But the one point that overlays this entire slide is, until or unless we get the virus under control, the recovery really can't take hold and go forward. It'll be in spits and pieces. It'll be 2 steps forward and 1 step back kind of thing. We've seen it already, even here in Texas, when we tried to open up in May. We went through June, then we had to close down the bars. We had to restrict the restaurants and other public things, cancel all public meetings, those kinds of things. So because everybody is struggling to figure out what can we safely do, what can we not do. Are we increasing? Of course, the number of cases went up, and Texas became a hot spot, and is still a hot spot. Although it looks like the trend in the number of cases and deaths and hospitalizations is at least trending down in the right direction, but it's still pretty high numbers anyway. But given that, watch for jobs and spending. Those are going to be the keys. Getting people back to work, putting people back to work that were laid off or furloughed or what have you. And then secondly, when they go back to work, how do they spend their money? Our economy, the whole economy, including Texas, including the housing market, depends on people having income and spending it. And spending it on goods, services, buying things, and buying houses, but buying furniture, buying everything, because that stimulates the economy. 2 to 6 months, the short run is really tough. I put this slide together about 3 weeks ago, so we're already into that 2 to 6 months. We're in the third quarter of this year. This is a critical quarter. This is the transition quarter, if you will, from having the depths of the virus effects transition into third quarter, and then hopefully by fourth quarter and on into the first quarter next year, really start seeing the real pickup and get back up to something looking like where we were before all of this started. The issue there, of course, is the fourth quarter of the year generally is a weak quarter, except for retail because of Christmas. And so again, we'll have to see how all of that plays out. You all are aware that a lot of companies rely on the Christmas season for their income. I know we're sitting here in August and I'm talking about Christmas, but the players, they're already thinking ahead for this. There's supply chain issues. A lot of the retailers are going to discover they're going to have trouble stocking their shelves with product because of supply chain coming out of China, coming out of Mexico, coming out of Asia. The global trade is not there, so it's going to be some difficulty. Medium term, in the next 6 to 12 months, think a year ahead from now, we should be better. The assumption is that somewhere in the next 6 to 12 months, probably more close to the 12 than the 6, we'll have some kind of cure or medicine or vaccine or treatment or whatever for the virus to get that under control and normalize the health impacts. Incidentally, when I say get under control, I have no earthly idea what that means. I don't know statistically, does that mean absolutely no cases, we eradicated, or just a few cases? I don't know exactly, but somehow collectively society will discover or decide that yes, the virus is more or less under control. Yes, some people may get sick and some people, but that happens every year. People get the normal flus that we've had for the last 25 years. So we'll have to see how that goes. Long run is going to be interesting, and you're going to see it in your market. You're going to see it in the housing market, the commercial real estate market, of what the long run impacts of this. We'll talk a little bit about that. It's going to be uneven. Housing, we think, is going to be the leader. Here's the good news for all of you sitting here this morning. We think that housing is going to be the industry leader and driver for the whole economy, because the housing market has recovered very well and is showing every signs of moving forward. We'll see that go forward in a minute. Now I'll give you some more information about that. Commercial real estate, that's what the CRE is. Commercial real estate is going to be mixed. It's going to be by type, by location. Hotels are in big trouble. A lot of them are in default and so forth on their loans. Retail malls around the country are having a lot of trouble. In Houston, I'm being told that a couple of 3 of the malls are going to have some troubles. The Galleria is going to survive. I know I just got a sigh of relief from everybody in Houston. And most of the malls in some of the major cities, the key malls will be all right. It's the secondary ones that we'll see. Major shift into capital markets. You guys, I know, are following what's happened with mortgage interest rates and borrowing and lending. And we're going to just have to see how that's going. It's making a big difference, though, at corporate level and for government borrowing. And that's government, not only the federal government, but state and any kind of local borrowing, the cost, the difficulty of getting it, a lot of the capital, a lot of the infrastructure expenditures that are made, of course, by states and local communities, that relies on borrowing. I know their operating budgets don't, but sometimes they're borrowing for other. Here's how we're doing. Restaurant bookings, these are things you've already been reading about in the paper. You can see that restaurant bookings are down by Open Table Network. This is in seated diners. I mean, some of you probably are already going to restaurants. I've been to a couple, but we're far away. The next table is 8 feet away and that kind of thing. So the restaurants are suffering. We'll have to see. Hotel occupancy rate is less than 50%, and I'm surprised it's even that much. Business travel, for example, nobody's traveling for business, or at least statistically, it's a severe drop off. Even personal travel is down. Room rates are down. The hotels have gone through a really, really difficult time period. Air travel, the airlines, very basically, they ought to have just thrown in the towel. Their business went down to zero, and you can imagine, if you can, just try to imagine the operating cost, the fixed cost of running an airline with all those airplanes running around and the gates at the airports, all the expenditures and the personnel. That they've really, and airlines don't make, arguably, don't make big profits, thin margins anyway. So the airlines are in trouble. That's why you're seeing the bailout on the airlines. Eventually, we really would like to have a few airlines operating in the country and keep them operating. And so that's what's happening. Unemployment claims. I mentioned this a minute ago. I put in the August 8th number. The latest number for last week just came out, and it's right at 1.1. It came out this morning, I think, 1.1 million. So I didn't have time to update the chart. It actually bumped up just a little bit from the week before. It was at 970,000 the week before. So anyway, it's right at that million mark, which you can see is a good sharp decline from when it peaked back in March and April. But look at the little black bars over to the left. That's what normal looks like. It looks like somewhere between 200 and 225,000 per week, not a million. So it's still nearly 5 times greater than the normal rate of unemployment claims. In April, the official numbers were in BLS that we lost 20.5 million jobs, and we're slowly regaining jobs, 2.7 in May, 4.8 in June, only 1.8 million in July. The August number, of course, we don't have. Unemployment rate running around 10% or a little bit better. Quite frankly, all of the economists are looking at the data. The real unemployment rate is probably running about 15 to 20% because a lot of things don't get counted the way they do it on the official number. Excuse me. So it's a little bit more than the 10%. About a total of about 15.5 million as of a week ago are still continuing. Those were weekly claims. So a lot of times somebody gets unemployed, they put in a weekly claim, they're unemployed for a couple of 3 weeks, maybe get a job, go back to work, then they come off the unemployment. These are the continuing or continued unemployment numbers. And actually there's about 30 million people total. And these are state unemployment, because the states generally run the unemployment insurance programs, but the federal government's doing it too. And there's about another 12 million getting federal unemployment. So that's the reason I was telling you that effective unemployment rate's a little higher than what the official numbers, but at least you can see that is trending down. Look at the very far left of that curve, and you'll see it was 1.7 million and 1.7 million in the early part of March before we had the real shutdown from the pandemic. Rita mentioned March 14th. There's March 14th there on the graph there, when the unemployment claims were about 1.7 million, 1.8 million. So you can see we're not out of the woods. That's the point here. Here's a graph I found out of the Wall Street Journal. It's a little old, and I'm not sure the specific numbers are exactly correct, but I think they're giving us proportionately, kind of what to expect. For example, on the retail, on the far left, shopping centers and retail, it may well be that about a third of the retail space is going to go permanently, or retailers, people that are in the retail business and operating out of shopping centers and freestanding retail, about a third of them may not ever reopen, or at least go out of business. Somewhere about half of all the restaurants are in jeopardy of not reopen. Just think in your mind, not the franchise restaurants, because sometimes the franchisors may be able to care, but even those won't all survive because the franchisees may or may not have the capital to keep their individual franchise open. But think of the mom and pop restaurants, the individually owned restaurants by individuals that are not necessarily chains and so forth. A lot of those, most of them might have 1 or 2 months of capital supply to be able to withstand a month or two of down business. They didn't expect those down business to be absolutely almost zero or as deep as it was. So a lot of those are simply not going to make it. Beauty spas, where you go get your hair done, where you go get your hair cut and so forth, those have suffered a good deal. Fitness centers, the gyms and so forth, because they were shut down and tried to reopen. We've even seen where some of them tried to reopen and then had to fight the police to stay open. It's been kind of a nuts kind of a situation, but this kind of gives proportion what some people are expecting. I'm going to point out a little later on, I'm going to jump ahead and give you some a little preview of sort of my summary at the end. One of the things I think this is going to do, though, is perhaps create some opportunities in that 1 to 2 year period of people who would like to get into business. They're going to discover maybe the market isn't as oversaturated with other businesses and have the opportunity to create. It's entrepreneurism. We'll have to see, and Texas is well known for entrepreneurism of starting up new business and so on. What's it going to take? Well, we got to get the virus under control. We got to increase overall demand. The real hit on the economy globally, nationally, state of Texas, and in each of your MSAs, everybody. What has happened in the last 4 months, overall demand for anything and everything fell. It dropped. This was particularly true back in March, April, May, and then a little bit into June. Both consumer, business spending, everything just dropped. We got to reemploy people. Global trade is not going to be any help. No, there isn't a country in the world that hadn't been affected by the virus. Every country, in fact, I got some statistics I'll show you in a minute. I'm an economist. You know those graphs and charts coming, right? There's more. But the global trade's not going to be much help. So the import-export, that's going to be a wash. Inflation is not an immediate concern, and by immediate, like within the next year. But I will tell you, there's a lot of concern on that longer term. When the government has borrowed this much money, poured this much money out into the economy, and we're talking trillions of dollars here, not just a little bit, we're talking a lot. That somewhere down the line, we're going to pay for that, and it's going to happen. Interest rates are indeed going to stay low. There's your good news for the morning. I know you can all tune out now because mortgage interest rates are going to stay down, which is going to stimulate the market. That's good for, any kind of prediction on interest rates is extremely dangerous because anything could happen. But as we see into our cloudy crystal ball right now, it looks like we're good for at least another year. Through third quarter, fourth quarter of next year, before we start seeing rates go up significantly. Now, they won't be exactly what they are now. There's going to be some bouncing around. That's just the way the world works. But basically, we'll stay low. I will tell you this: taxes are eventually going to go up. The government sector is eventually going to have to do it. They ain't going to like it. The politicians are finding every way they can to hide or disguise or postpone raising taxes, but there's no way. Fed, state, local, it's all across the board because they're all forced to spend money that they didn't have and don't have on things that they didn't anticipate, particularly the virus. And ultimately, they're going to have to pay the piper for all of this as it comes up. Here, let me go through. I'm going to go through some of these slides. Consumer confidence index from the Consumer Board bounced down in July. That's the little right over there at the far end on the right, the little downtick in July. August will probably come back a little bit. Haven't seen the number yet. We're looking for that to come. You see the dramatic drop from February to May. I mean, that's an economy that fell off a cliff. And that's what happens when you get this unprecedented mandatory shutdown that we got in toward the end of March, when everybody was told to go shelter in place, stay at home, don't go anywhere, don't do anything. Businesses closed down, shops closed down, restaurants closed down, hotels closed, airports closed, you name it. And when everything just stopped, it doesn't take but a month or two to start showing up. Uptick in inflation, mostly the energy. It's ironic. The $40 a barrel oil brought gasoline prices back up at the pump. and so that brought the rate up a little bit for the CPI. Although now it's all steadied, so we won't see that. That's a temporary kind of thing. The core CPI, that's the CPI taking out food and energy. That's because none of us drive a car or eat. And so they do look at core, and you can see there's a little bit of an uptick, but it's still less than 2%. The Fed has recently said they're going to allow that, or in fact, they're trying to get it to. There's not a matter of allowing. They're trying to encourage and get the inflation rate back up close to the 2.5% or even 3% range to stimulate the economy and get things going. Retail sales are bouncing back. June, you can see the July number. It's the little bitty bar at the very far right. Basically, we're almost back to where we were in January. So people are buying, and so that's a good thing. These are seasonally adjusted. Small business optimism, and of course, most of the real estate companies fall into this small business category. They fell off the cliff from February to April. No surprise. Has come back up. July dipped a little bit. That was because of the second wave of the virus caused some downturn in some of this stuff. We're figuring that August is going to come back up again. And we'll see how it goes. Interest rates. Interest rates are going to be low. The federal funds rate, which is the green line, that's the rate that the Fed deals with every 6 weeks when the Federal Open Market Committee meets. And it's going to look kind of like over there on the left where it's that flat down right close to zero. It's going to look like that for the next year or so. The blue line is the 10-year Treasury at historical low. It's running right now about 0.6 to 0.7. I can tell you the real rate, economists are always inflation adjusting things and calling it the real. The real 10-year Treasury is negative because inflation's running roughly about 1.5 points. And if the 10-year Treasury is at 0.5 point, when you subtract them, that's a -1. So the real 10-year Treasury is running negative. The reason it's so low is that the Fed's bonds and notes are very attractive globally, and everybody's buying them, including the Fed. The Treasury issues the 10-year. The Fed is buying them and keeping the rates low. The 30-year fixed mortgage rate, sorry about that. I get excited about all this, and though I lose my voice. The 30-year fixed mortgage rate, you can see, is really dropping. These are monthly rates, so it hadn't hit 3% yet exactly for the month, but it will. In fact, most of you can probably tell me stories of this lender or that lender making 30-year loans right at the 3% level. If you go 15-year with a down payment and a really good FICO score, you're probably well under 3% to buy a home today. So that's part of what's fueling what's going on. Here's a slide that you'll find completely boring, and I normally don't include it in these kind of presentations, but to indicate to you how it's the whole world that's gone into a tailspin here. This is from the International Monetary Fund. This was their estimates for 2020, and then their further estimate out to 2021 for a host of countries. The advanced economies are the big 20, if you will, with the U.S. and Europe and Japan and Great Britain and Canada. And you can see overall we're expected to go down about 8%. Now I've seen different numbers on that. I've seen as good. We'll do as good as only a -5%. I've seen as much as we do a -12%. So there's a lot of variability here in all this. But if we go down 8%, you can see the rest of the world is no help. And in fact, a lot of the rest of the world doing even worse. Even if we come back nearly 5% in 2021 up there, that doesn't bring us back to even. If you go down 8% and come up 5%, you're not back up to even yet. So it's really think in terms of being out even to 2022, and that's assuming nothing else happens, that we don't get any other kind of impact, flu, hurricanes in Texas, what have you, to affect us. And then, of course, it holds off to the side whatever happens in November in the national election. And that's I have no idea what's going to happen and what to do with it. Here's what it looks like on a graph. In the first quarter, we were down 5%. We were down nearly 33%. Second quarter, that's that worst on record, that buzzword I gave you a little bit ago. On a year-over-year basis, second quarter this year to second quarter last year, we're down just a little less than 10%. So it's that 33% is a scary number, but it's what's called an annualized quarterly number. Okay, government statistics, but the year-over-year change about 9.5%. We can make that up. But we'll probably still be negative for the year. Texas, we're starting to recover with ups and downs. It's going to be staged or phased. The governor was right about that. I mean, the only way to do it was to do it in phases and so forth and hope for the best. it's one of those things you're really glad you're not the guy having to make those calls. If you really want to know, I don't want to be political. I don't know whether it's good or bad. I just know I'm glad I'm not the guy who has to make the call on that, of what to do and when to do it and how much to do. It was a no-win kind of thing unless we just got real lucky. Job recovery, consumer attitude, spending, all the things I talked about. The businesses, put businesses back into business. One of the things that with the bailout, the PPP was a really good idea. I'm not sure how effective it was, but it was a really good idea to try to keep small and medium businesses and even some of the bigger businesses keep their payrolls up and allow. But I think when it was first started, the expectation was that it'd only be a couple of 3 months. It's gone longer than that, so it's been difficult. The energy market is not going to be the same. Don't expect it to be. Don't expect heavy recovery. I'll show you in a minute, but the price of oil just isn't going to get there to really reinvigorate the hydraulic fracturing industry. It's going through mergers, acquisitions, fallout, bankruptcies, and so forth, job losses. That's going to continue until it reaches the balance stage of what makes sense with the current prices. Housing, though, is not only should rebound, it is rebounding very well. I'm going to get to it, I hope, eventually here. State and local government budgets are going to be hard hit, and they're just starting government layoffs at the state level, some of the agencies. The school districts couldn't, but they're running really difficult for funding. City and state governments are difficult. Here's what Texas unemployment claims look like. You can see that there's been a steady decline. Then it bounced back up in early July and then declined again. We're still multiples ahead of what would be considered normal, the little black bars over there to the left, when you compare the numbers. So we're getting there, and we're working at it. Here's what it looks like around the state in terms of total unemployment claims. Clearly, Dallas and Houston are going to be ahead because they're just simply bigger. There's just more people. But you can see how Austin, San Antonio, I didn't have all the others. The border communities, I can tell you, got hit pretty hard as well. We do a border report at the Real Estate Center. I encourage you to look at that. For those of you in the El Paso or the McAllen or the Brownsville markets, we put that out quarterly to try and keep hold of what's going on down there. And you can find those numbers on our website. If you look on the far right, that's what we looked like June a year ago. I don't have the July numbers yet on all this. So June a year ago was for the state was 3.4%. Now we're at 8.6, more than double. Went up to 13% estimated in May. May was the bad month. May was the black month of the year so far. So everything's going to get compared to May, and you can see how. Okay, from May to June, that's a big improvement. And if into July and August and September we can keep it moving, we'll probably go to something. I don't know, somewhere between maybe 5 and 6%. We'll be lucky if we get to 6. We'll be astoundingly lucky to get to 5. 3.4 right now is out of sight, but that was you got to remember that was almost a record low. It was not the record, but it was in the range of record lows. 3.4% unemployment generally is not sustainable. You don't stay there. Generally around 4 to 4.5 is more normal. So if we can get back down to maybe 6 or 5, we'll at least be approaching where that is. Here's the leading economic indicators. You can see it is trying to bounce back up in June. They haven't released the July number, but this is what it looks like. The big difference between the drop over there on the far right and the drop there during the Great Recession from 2008-9 is that between 2008 and 2009, it took 1.5 years for that drop to occur. This one occurred between February and April. I mean, it really did drop off the cliff in such a short period of time. And it's not reasonable to expect it to bounce all the way back up to what it was in February, but we need to get somewhere back up close to it. We'll have to see how it goes. Here's the oil and gas. Here's the picture for this. I was talking about the price of oil, and back in January, February, the price war started. And you can see starting in January of 2020, that's when the real decline there in the orange line, the West Texas Intermediate dollars per barrel, that's when that price declined. It bounced way down back into April. Again, I tell you, on one day it got negative, but for that week, and these are weekly numbers, actually these I think are monthly numbers. For the month it averaged about $3 a barrel, which is effectively zero. And it has bounced back since then. And you can see it's starting to level off here around that $40. And then the rig count. And I got to tell you, historically, as an economist, we could measure the economy of Texas by this graph, the rig count graph. If it went up and down, the state economy did. That was true 50 or 60 years ago. It is not true today. The state has grown, diversified, expanded beyond energy. And the non-energy sector of the economy now in Texas is big enough that when the energy sector has a kind of drop-off that you can see here in this graph, it doesn't create the same kind of economic impact as it did, for example, back in 1985 and 86, when it threw us into a complete depression in the state of Texas. It's also true the banking system is different. The S&Ls, we don't have 700 S&Ls to go broke. There's a lot of differences, but the economy now is, the state's economy is better able to withstand this kind of a fall off in energy and not go into a complete tailspin. Now, that doesn't help you if an individual who works for one of the energy companies or one of the service companies and loses their job. I'm sensitive to that. I'm looking at the broader picture, so forth. Here's the best example of what I was talking about earlier of overall demand falling. The global demand for oil within a month dropped 20 million barrels a day. And we were already oversupplied in oil, and then the demand dropped. Until the demand for oil comes back, the price won't come back. Here's what Texas did. In the 20 teens, I love it now. We can get and talk about the 20 teens, the decade of the 20 teens. And I'm going to tell you, when all of you are a lot older and you look back and over your life, the 20 teens are going to stand out as an outstanding decade for Texas. In fact, my guess is, aside from maybe a couple of decades early on back, 200 years ago, in terms of percentage increases, we may not see this kind of growth in terms of numbers and percent again. I mean, when you average 275,000 almost jobs a year, and you're averaging almost 425,000 people a year, in a couple of years over 500,000 people. I mean, that's phenomenal growth for any state. And we were already a big state to start with. So, and my point of all this, and this morning, is the 2020s aren't going to look like this, I don't think. It will be difficult for us to replicate this rate of growth. It doesn't mean we're going to fall off the table. It doesn't mean we're not going to, because people are still going to come to Texas. We've still got affordable housing. We're creating jobs. We've got weather. I know it's hot. It's 105 degrees probably for those of you in Dallas today. And then even throughout the state, it's about 100 degrees here in College Station. Or it will be here later today. And we got the best Tex-Mex food in the world. So we're still attracting people. It'll still be attractive to come here. We just may not be able to replicate all of this kind of growth coming forward. Here's the projections. We added about 14 million people the last 40 years. This is to the 2010 census. And that's another thing. The 2020 census. Has anybody got a clue of what the impact is going to be on the 2020 census count? I don't. I just know that there's going to be all kinds of of posturing and labeling and people running around and scurrying around. I wouldn't be surprised if they delay the release of all the data. It's always officially as of April 1st, but we'll have to see. The next 40 years, we're probably going to add 20, 30 years. We're not 20, 30 million people. We're not going to add the 40 million. We'll have to see. But you can see that the revised projections based on the 2010 to 2015 rate of growth in the state was lowered, and that's just extrapolated out. There's nothing magical about this. It just extrapolates out, but you can see it comes out to about 47 million people. The growth is still going to be in the urban triangle of the Dallas, at the I-35, I-45, I-10 triangle of the state, with a few other blue counties. You can see Lubbock and Amarillo and Midland out there in El Paso, Brownsville and McAllen down in the valley are still expected to do well, but it's still expected to concentrate around our major urban areas and within the urban triangle of Texas. Let's talk a little bit about the real estate markets. We mentioned the mortgage forbearance that is beginning to trend down. It's very slight. It hadn't been real noticeable. We're talking roughly tenths of decimal points so far. Don't have the July numbers haven't been released. I think they come out this week or next week, early next week. But new home sales went up almost 14% in June, increased by 20% on existing. That was because there was such a fall off in April and May. A lot of the demand got pushed into June, July, and August, and that was true in Texas. I'll give you the Texas numbers. Median home prices are rising. They're going to continue to rise. There's still a shortage of housing. We just don't have enough relative to the demand of the households being created. One of the things that's going on demographically, and some of you may be, and in fact, a lot of the students, I'm sure, are millennials. They're in the 20, 30 something age bracket. And one of the things the millennials are now learning, to their chagrin, because there's nothing they can do about it, they're getting older. And the upper end of the millennials are now 35 to 40 years old and gotten married and maybe had a kid. And the early 30s, the 33s and 34s and 32s, they're beginning to get into the cycle. So what's happening is looking for housing. A lot of it is moving now to the suburbs. That's one of the things that is coming out of the virus. It's been interesting. It's accelerated the movement of people looking and demanding maybe out into the suburbs, maybe even out into the exurbs. I'll talk a little bit more about that. But home prices are still going up because overall, that demand feature that I was talking about for the overall economy, that demand feature for housing, and that's rental housing to some extent as well, but particularly for home ownership, that demand is coming up, and it's coming up very strong. The second quarter of this year, the national home ownership rate jumped 3%, 3 point something percentage points, went from about 64 to just shy of 68%. And that's a record high for home ownership in the US. So we're seeing that. Mortgage rates hit all-time low. Housing starts are surging after dropping. We had 5 continuous months of decline in housing starts. That's coming back up. Here's the graphic for home sales, new home sales. You can see it's bounced back up to about where it would have been or what you would have expected after the dip. That's the V shape right at the end of the orange line out there. You can see the existing home sales are trying to bounce back after a significant decline in the March, April, May time period. But June came bouncing back to 20% level. The biggest thing holding back existing home sales, though, is the lack of inventory of listings. Year-to-year change. This is the single-family purchase mortgage application. This is sort of a leading indicator. If people are going out today and applying for purchase loans, this is not the refis. These are loans to purchase a home. When that's up 20%, that's telling you that people are out in the market and buying homes. And of course, you generally get your mortgage application in anywhere from a week to 4 weeks before the actual closing, and you count the closing of the house. So that is one of those indicators. Now, some of that is the pent-up demand. The big drop back there in April when it went negative 35% and so on. Some of the reason for that increase then is that pent-up, it pushed it forward. We're not going to stay at 20% ahead of last year. That's going to fall back. And don't be surprised if you start reading the paper that single-family purchase mortgage applications are only up 10%. Well, that's okay. That just means it's back kind of to where you expect it to be with normal, quote unquote, normal growth. I'm kind of warning and how to interpret some of this data. Housing starts. The home builders are really optimistic. That blue line, that's a home market index. That's a survey index of the home builders that NAHB does around the country and says just, are things going well or are they not going well? And it's a matter of, if more than half of them say that it's good, then it's good. And if more than half say it's bad, it's bad. That's the reason the red line there at the 50% mark there for that. And that's what it applies to. That's a record high, incidentally. It's just shy of 80% of the home builders surveyed said they're optimistic about. Now, they break this survey down. There's about 10 or 12 categories of traffic flow in the next 6 months and current sales and homes under construction and supply and so forth, labor market factors. So this is the composite of all that. And you can see that the home builders around the country, and we've been talking to home builders here around the state, they're the same way. Most of them are telling us they're just as busy as they can possibly be. Their only problem is finding vacant lots to build on, and they are having some labor problems because they've got to fight the virus and do distancing, and then have a problem if somebody on a crew gets sick and that sort of thing. And then thirdly, the supply chain. Lumber comes from Canada and a lot of it, and the price of lumber has jumped up almost 100%. So it's been really, really difficult in some cases to get as many homes built as they'd like. I'm showing you this graph just, I don't know why. This is what we thought at the beginning of the year. This is what we thought the state housing market would look like. We thought home sales would be up somewhere around 3.5% to 4%. We thought home prices, both average and median, that's the blue line and the red line, would be up about 4%, over 20. And this is what's happened. Here's what I wanted to show you. First quarter, this is data, incidentally, you can go to the market viewer for those of you who are realtors or become realtors and download these infographics from there. That's my advertisement for them, I guess. This is the Texas Housing Report for the first quarter of the year. Notice that prices were up 5%, sales were up nearly 9%. Months inventory down there was about 3.2%. Yes, I took this from Sabor. The active listings, though, that was down 4%. That was the precursor of the problems. Look up there in the top right corner, though, and what you will see is that roughly 60% of all of the home sales in the first quarter were between $100,000 and $300,000 in price. It's not true that everything going on in Texas is $500,000 and up. It simply isn't true. There's still very good, very strong demand. Now look at second quarter. Here we go. Worst, on record. Closed sales over there on the right circle down 10% for the quarter. Active listings, and that was the key, were down 22%. What we discovered was when the virus hit, the shutdown hit, anybody who was thinking about selling their home had second thoughts. I don't want strangers walking into my home. I don't want to have to get out. Everybody's shut down. Even if I sell my house, I have to go out and find another one. All those kinds of problems. And that's still going on to some extent and keeping the listings down. Median price, though, was still up. So what was going on? And incidentally, months of inventory down there at the bottom right, if you'll see it, actually went down from 3.2 to 3.0. And the reason for that is that the listings went down. The listings are the supply, the sales are the demand. and listings went down faster than sales to actually lower the months of inventory. This is how we economists can lie with statistics and tell you all kinds of stories. Here's what happened in July around the state. And I'm using this because what you'll see over on the left-hand graph or the left-hand map, the green, especially that urban corridor, the I-35 corridor, the Houston area, even on down into the valley. The only negative areas, Texarkana, a little bit negative, down a little bit. That's been sort of a trouble market for the last year or two anyway. And then San Angelo and then Odessa. And I don't think any of you would be surprised to know that Midland and Odessa have had housing issues here for the last 6 months because of the energy decline. What might surprise you is that Midland was actually up a little bit. That's the two green counties. I think it's, well, whatever it is. It's Midland and Howard, I think is the name of it. The two counties out there. So it's interesting. And the activity is still there. It's just the total sales. But what I want to point out, then over on the right-hand map, this is the price levels. And what you can see is around the state, prices in general are up. Now, they're up somewhere between 1 to 10%. So they're not up astronomically, but they are nevertheless up. And this is incidentally based on the average price per square foot of the home sold, not the average price itself, but the average per square foot. We think that's a more common way to measure real change in home prices rather than just averages and medians in local markets, because it puts it kind of on a common denominator. So we see this. Here's March. That was the last of the good months, if you will, in the state. 3 months inventory, sales are up only 1.4%, but that's because the last week of March, that was when it really started falling. Dallas actually was down a little bit, but you'll notice year to date, Dallas through March, January, February, March, first quarter was up 7%. You'll see Houston was up 6, Austin was up 2, San Antonio up about 1%. You'll see months inventory over there at the far right. Everybody was tight. That number should be somewhere around 6 to even 6.5 maybe for some markets. When it's 3 or less, you're really tight. And when you're down like Austin at 1.6, in Aggie speak, you ain't got none. There just isn't any inventory to sell. Here's what May looked like. May's the bad month. I told you we're going to compare everything to May. May was down 23, 24%. You can see how it was in the high 20s. San Antonio up right at 20. But that month's inventory stayed tight. Active listings were tight. June, the data turned around. That was our turnaround month. Sales came back up about 14%. That was from year over year, and that's good because this June was better than last June, and last June was a pretty good year. Year to date, we were still down about 2% in total after absorbing the downturns of April and May, and you can see what it looks like in the other. But the active listings coming down, months inventory 3 months. And then you can see it's right at 3 or less than 3, for the major MSAs. Incidentally, you can go to our website, get all the same data for all of the MSAs. I just didn't have room here on the slide. July continued the good news. July even better than last July by 22%, and it reversed. Year to date, we're now 2% ahead of the year, because of such a strong comeback in June and July. But active listings are still down about 25%. But look at what average and median price is doing. The demand is pushing the upper priced homes. The people who still have their jobs and are still working and demanding the higher prices are doing a little better than the lower priced properties. A lot of the lower priced properties were newer homes being built by builders and coming into the market. This is everything through MLS. So we don't pick up the whole new home market. We only pick up new homes that are actually sold by realtors or licensees through some local MLS because it's the only way to collect the data. And you can see the month's inventory continues to fall. Prices across the board in each of these markets, the average and the medians going way up. But you can also see the number of active listings, and this is year over year. So this is active listings in the month of July relative to how many listings were there before. And you can see the decline there. There's one of your challenges when you come out of the school and you get your license and you go into the market. Your challenge is go find listings, go find inventory. Single family building permits, actually we're running about 9% ahead of last year, the first half of this year. I wanted to show you the relative time periods. For those of you who if you're at least old enough to remember the 80s, there was the complete fall off in the housing market and real estate in general in Texas. And it took 16 years for the home builders to get back up to what the prior peak was. Well, look out here at 2005, we peaked out at 166,000 units. We're 15 years out there and we're still not close to that peak. That was unusual times. That was especially when basically the ninja loans, no income, no job, no assets, give me a loan anyway, that kind of thing with the borrowing and the funny money. So it was that way. But the low interest rates are going to keep these the building permits up. The green bar there is my guess, and that's all it is. Actually, it's a projection if we continue the 9%. If we can stay at 9% ahead of last year through the year end, we'll be somewhere in that neighborhood there as shown. Let me kind of summarize. The forbearance issue is going to lead to foreclosures. I just don't know how heavy. We've gone through that before back in 2009 and 10. Coming out of the Great Recession, we went through the period of high foreclosures, distressed sales, short sales, and so forth. It'll be a little bit different this time. It won't be as large. It won't be as many. There's also all kinds of information coming through about numerous iBuyers, institutional buyers, funds that have been created to come into the market and try to buy these properties, generally with the game plan of turning them into single-family rentals. We're seeing a lot of rhetoric and a lot of propaganda. I don't know yet that we're seeing that much actual activity in that level of market, but it's to be anticipated. Think about it and think about as you go into your business and decide how your business model is going to work for your company or for you individually, what that might mean to you and how you might deal with it. We've had the potential end of moratorium on evictions. A lot of people would like to move over from being a renter in an apartment and move over into the single family ownership market. Some are being evicted. Data that just came out this morning, I was looking at National Association of Multifamily Housing, rent payments for August. And everybody thought that with everybody going unemployed and so forth, that delinquencies and rent payments at the apartments would just go through the floor and so forth. Hasn't happened, mostly because of that extra $600 a week in the unemployment. Now, it seems to have carried over to August. The number is it's only down about 2% in terms of non-rent payment relative to what it was August a year ago, which was considered a normal month. So most of the tenants are being able to hang on and pay. Now, they're doubling up. A lot of people are discovering that, okay, well, instead of me having my unit, you having your unit, we'll have a unit together. So vacancy rates have gone up, but rent payments have not gone that bad. Low interest rates are still stimulating the housing market. Here's something, and this could be a whole new, this could be a 2-hour, a whole day presentation, but the new technology and new processes for everything, for the way houses are developed and properties are developed, to sales practices, brokerage management, the whole game has changed and changed rapidly. It was changing in the prior 2 or 3 years. New technology, the use of the internet, marketing through the internet, virtual tours and all that. But just think in the last 5 months, how that whole thing has accelerated and sort of almost become, it was the only way to conduct business. A lot of people were surprised to find out that people could go out, look at a house virtually, negotiate it, sign a contract, get an appraisal, even maybe get an inspection, although that was a problem, but go through the title process, get the loan application, get approved, and never see anybody face to face. It could all be done electronically and digitally. So the processes and the technology is changing everything. Home construction, we think, is going to be a prime recovery activity. When we talk about housing as economists and helping the economy, really we're talking about new home construction because that's new. That's new investment, everything new carpets, new furniture, new everything. So it expands the multiplier effect, if you will, on new construction is very tremendous for helping the overall economy, because somebody else has got to make the furniture, somebody else has got to make the furniture, carpet, somebody else has got to produce the light bulbs. I mean, you just keep on going and you see the investment. Commercial real estate right now, kind of wait and see. Cap rates are going up. That means prices are going down because people are looking for yield. They're looking for return. A lot of people worried about who's going to survive, who's not going to survive, what's going to be available. That's going to be one of the opportunities, though, on down the road a little bit for entrepreneurs who maybe want to start a business. There may be brick and mortar and physical properties available at more attractive prices or rents than there were before. I tend to be a guy, the glass is half full instead of half empty. So I'm trying to see these opportunities of where we might see things yet. And I'm going to tell you right now, and this is a big issue among the appraisers. In fact, I just talked to two of the local groups of Institute of Appraisal Institute people, the MAIs, and they're telling me, and we're telling them, because we're looking at the data, same data. We have not seen, and especially in the housing market, value impacts yet across the board. We haven't seen any real negative value impact. As I was pointing out with the data a minute ago, averages and medians and price per square foot are actually up. Now that's obviously at a broader perspective. There are obviously, and this happens even in the really good times, there are individual neighborhoods and individual subdivisions that may or may not be doing good and may even be declining. But across the board, there's been no real value depression effect on real estate values, and they've maintained and actually increased what they're doing. Let me, the best two words that any economist can give you in a presentation, in conclusion, that means I'm fixing to shut up. What we may be seeing is maybe not the end of the urbanization movement, but perhaps a significant lessening of the urbanization movement. We're seeing more and more people looking to move to suburb sectors. This may hold true particularly if we continue at the number of people who are working from home and teleworking and telecommuting and so forth, and don't necessarily need to have to travel in and go to an office every day. They can go wherever and work wherever they want to. And we're hearing all kinds of anecdotal stories about that. I've seen some recent data that have come out from a few of the survey people who are saying that, prior to the pandemic, maybe somewhere between 5 to 10 to 12% of the workforce worked at home. Most of you knew people who were working from home even before all this started. But the current statistic is that close to about 35% of people are working from home, and that may not fall back down to where it was. It may stick, thinking of it that way, at somewhere maybe between 20 and 25% of the labor force working from home. Well, that gives you more spatial flexibility of where you can live and where you might want to live. If you've got a family, you may discover that living in a small community outside of a big town is more appealing for raising kids and so forth than living in the central city. We'll have to see how that goes. It is interesting that not once have I seen the word urban sprawl mentioned in any of the literature, but I know it's coming. It is coming. So watch out. Home affordability is going to be one of those driving factors. One of the reasons why a lot of households are moving suburb and the smaller community, the price of the house is simply less, as opposed to being closer in. And you all know that. You're all seeing it every day. The demand, what kind of houses do you look for? Larger houses, more rooms, open space for community, for communal things, the kitchen, living room, dining room where you watch TV, but then more rooms. And now 2 offices, not 1. Because if everybody's going to be working from home, I can tell you, if your husband and wife are both working at home, they want separate rooms. They really don't want to work in the same room. So you're going to need that. And then multiple primary bedrooms. Incidentally, primary bedrooms has become the word for master bedrooms. It's now primary bedrooms. So anyway, smart homes are a necessity, especially if you're going to work from home. But that was happening anyway. This is the acceleration, if you will, of some of the things that were already in play and movements and things that were trending forward anyway, and now are being accelerated from the last 6 months of activity. I mean, Facebook and Twitter both have already announced they're going to have their entire labor force, everybody that works for them, is going to work from home through next summer. And there are going to be other companies that are going to be able to do this. Austin area with the high tech, particularly, we're looking for that to happen. Dallas, Fort Worth also with a lot of the services industries that are based there that can do a lot of their employees work from home and so forth. And they're discovering productivity doesn't necessarily get hurt. So we're looking for those kind of things. We don't know who else. One of the issues that, and I raised this actually with a private provider here the other day, and they just sort of went quiet. And that is universal Wi-Fi, public good. I can't believe that our school systems are really opening up with online education. And I have read where as many as 10 to 15% of the students don't have access to Wi-Fi or internet connection, broadband internet connection. Most of the schools, is my understanding, have been able to handle the physical thing. Do they have a computer, which is another issue? But they've been able to kind of handle that. But getting the service and having an adequate service for the online instruction is a big deal, and may force the issue of whether Wi-Fi is a public good. A public good is like a utility, electricity, water, sewer, those kind of things, where it's provided by the public sector. Yeah, there's a fee, there's a cost, but it's there. I appreciate, Rita, I have finally run out of gas here. And I'd be happy if somebody had a question or wanted to talk about something. I saw a couple of hands go up.
Dr. Gaines, as I said to the group starting out, I thank you so much for being here today. And as I mentioned to all of our students and our instructors, I wanted to absolutely turn it over to you, have you go through all of your slides, because this is probably one of the most important period in time that we will ever go through. And we so appreciate the information from the Research Center. I want to say personally that your slide 35, if nothing else, as an agent, I would go to recenter.tamu.edu to print off some of those amazing pieces of information for buyers and sellers. Slide 35 to me really was just excellent, said so much. And all of those slides are available. I actually let it go over by maybe 15, 20 minutes because—
Sorry about that. That's my fault.
No, it's not your fault, because you have wonderful information that we all need as professionals and entrepreneurs. And we always thank you so much for your time to impart the information that you bring to all of us that are licensees in the state of Texas. So thank you, students. Thank you, instructors, for being very, very involved and engaged in Dr. Gaines's presentation today. And September 8th, we will open with a limited opening. Right now, you can come by all of our campuses and pick up your textbook if you choose to do that. And as we mentioned in our opening PowerPoint, we have 2 super books, The Successful Tendencies of Real Estate Champions 1 and 2, $14.95 each, $25 for both. And why are they awesome? Because people that are in the business, new but mainly long-time experienced, are telling you their story and what they do every single day to be successful. Dr. Gaines hit quite a few points on the financing part and interest rates. Month after next, in October, we'll have 2 longtime top producer mortgage brokers talking to us about the financial market. But the information today, if you're brand new, I want you to know it is so, so important to lead you to answer questions with buyers and sellers where you are knowledgeable and it gives you more credibility. So again, Dr. Gaines, Research Center, we love our Research Center. And you as the chief economist, tell us why it is such a great success. So thank you again, Dr. Gaines. Thank you, the Real Estate Center at Texas A&M University. And thank you to our students and our instructors and our staff. So I will see you next month, if not sooner. And we hope and believe we will see Dr. Gaines in January to kick off 2021. So have a great rest of the day, great rest of the year.
Thank you.
Bye-bye.
My pleasure.